everyone, this is Abhijit Chatterjee recording our weekly session of Chartsarefun. This is for the end of June, the week of June 23rd, recording this on June 29th, Sunday evening. We know that the market has come up a lot since the April 7th low, and there are many that are kind of looking for a breather. That said, we will share some data on Barron's, saying that July is historically strong month for the market. We'll look at Dow Jones, S&P, for example, according to this article on stats from Barron's, has the highest average monthly gains. So July is traditionally a very strong historical month for S&P and Dow Jones. And for Nasdaq, it's not bad. It's also one of the strong ones, but the strongest one happens to be January. So we'll look at that. What we will look at is from the economic calendar this week, there is the June unemployment data and the non-farm and ADP job data. So we'll be watching that. They come out on Wednesday and Thursday respectively. July 4th is a holiday, so instead of the usual first Friday of the month, this time the non-farm payroll comes out on Thursday, July 3rd. We'll look at a key indicator of the market getting a bit complacent, which is volatility or VIX. It's giving us a signal. We'll see what that signal is. And we believe that perhaps there is a possibility, while many expect a seasonally strong July, that maybe we get a bit of a dampener or a bit of a pullback in the S&P 500. We'll see what that could pullback be and why we could get that pullback in S&P 500. We'll also look at Bitcoin that is setting up as an extremely bullish pattern. We'll tell you what we think that bullish breakout, if it does shape up in Bitcoin, could point it to. We will look at the indication of the July meeting that the Fed is going to have. There's been a lot of discussion recently, a lot of name calling by President Trump, Chair Powell, been a lot of pressure on the FOMC to cut rates in July. And one of the voting members in the Fed, he is Treasury representative in the U.S. Treasury since 2020, elected by or nominated by President Trump back in 2020. He has been kind of dovish, and he has been in the market, in the news media, talking about a 25 basis point. His name is Chris Waller. So we'll see what the Treasury market did. So there are many duration Treasury bonds. We look at what the Treasury bond 1 month is telling us. What is it signaling us? And then we will look at a couple of interest rate sensitive sectors or market segments. One is the home builders. We'll look at what that chart is telling us. And then we'll look at small caps, extremely sensitive to interest rate stocks. We'll look at the small cap ETF, which is IWM. And finally, end with an article on Barron's over this weekend, indicating some bullishness in the bond market. We look at a longer term chart of the long term treasury ETF called TLT, and that's the long term treasury, 20-year treasury indexed ETF called TLT. We look at what the ETF TLT chart is, a long term chart is telling us, given that Barron's talked about a very bullish article on bonds moving forward. So, with that, let's jump into our blog site. It's called chartsarefun.substack.com. We appreciate you subscribing to it. And when the blogs come out in the morning, usually around 7 a.m., you'll be emailed the blog as soon as it comes out. Our YouTube site is Charts Are Fun. As we've always said, we believe that charts are tremendously insightful. We consider them as key guiding indicator for your trading decisions. We don't provide investment advice. We are not registered investment advisors. The goal here really is to give you some insights on charts and find the exercise of chart reading a lot of fun exercise. That's why we call it Charts Are Fun. It's our Charts Are Fun at youtube.com is the channel. Appreciate you subscribing to it, and if you like the videos, hitting the like button. So in the US economic calendar into this month, first week of July, fairly light. We know that July 4th is a holiday, but the key that we want to highlight is ADP. We know last month was a very low ADP. This is the private employment payrolls. 37,000 is all that we got in May. So we'll find out what the June number is. Market is reset some of the expectation, expects 120,000 in June. So we shall see what if there's continued weakness in the private payrolls in June. So that's what we will find out. Now, on the non-farm payroll, where the government jobs are also there, that had a bit of a positive surprise in May. Market was expecting 114,000 and it came up as actually 124,000 was what the market was expecting. It came out 15,000 higher at 139,000. Coming back to the month of June, non-farm payroll is expected to be down again from like the expectation. They were expected 124 in May and 115 in June. We shall see what we get, but from 139 to 115 would be a decent drop of non-farm payroll. So that's something we got to watch. And the unemployment number, which has stubbornly been at 4.2, is expected to rise to 4.3. So that's something we got to watch. The market is expecting that anything in terms of weakness, we know that the Fed has a dual mandate. They do monitor the job market and they also monitor inflation. We know inflation has been fairly tame. It has been steadily coming down with respect to CPI and the PPI. So now it's really the job market. If the job market shows signs of weakening, there's potentially a possibility the Fed could consider, instead of this wait and see approach, which the biggest concern is the tariff related inflation that comes into the market. But the factor is that if the employment starts weakening, that part of the mandate may kind of prod them or may kind of guide them to start doing rate cuts. That's what the market is really waiting on to signal for the. We did the last rate cut in December. So we started off with the 50 basis point September last year. Then we did one in November. As you know that Fed meets every 6 weeks. So September 18th was the first 50 basis point cut, then a 25 basis point in early November, right after the election. And then, in fact, the day after the election results, or the day of the election result, that we got that. And then we got the next cut on December 18th. And since then, there's been a pause. There's been a pause, Fed watching data and not very confident to make any rate cuts yet. So we'll see. We'll see what happens. The key thing that Marketwatch came out an article talking about seasonality, and this table here shows you average seasonal gains on every month, January through December, and we can see that there are a couple of for 3 months in that the Dow Jones tends to be negative. February, May, that's where the adage of sell in May and go away comes. We can see May, and then in September. We know that September, October is just overall a seasonally weak month, particularly September, and then early October is when the market bottoms. And we can see across the board in all the three key indices, Dow Jones, S&P, and NASDAQ, negative average monthly performance in the month of September. But going into July, 1.5% for Dow Jones, 1.7% for S&P. Look at all other months, that's the strongest. The next strongest is in December at 1.3 and January in 1.2. But the strongest for S&P 500 is in July, an average of 1.7%. And for Dow Jones, the strongest is July at 1.5. The next strongest is also for the Dow Jones in December at 1.3. So 1.5 for Dow Jones, 1.5 for S&P. For NASDAQ, the strongest is January. 2.5 is what the NASDAQ does, and reasonably good gains at over one, at just about less than 1% at 0.9 for the NASDAQ. And so we got to see. This is what the MarketWatch article talked about seasonally strong July. But if you look at the volatility, which is the market fear gauge, it's determined really based on options premium in terms of the put and calls out there in the S&P 500 futures. What we can see here is positive divergence setting up on a VIX, in the sense that as VIX climbed lower lows from the 17s to the 16s to the low 16, we touched 16.12 on Friday. So you can draw a line through the lows, lower lows. There is higher lows in RSI and higher lows in MACD. This indicates potential possibility of the VIX to reverse higher, to have an upward trend in VIX. That would effectively point to an upward trend in VIX would point to a market pullback. So let's look at the S&P 500. It finally took out its February high. What we can see is a successive set of higher highs, just below 6,100 at 6,099.97 in kind of December, mid-December. Then we touched 61.28 in January, and then into February 18th when the market topped out, or February 19th when the market topped out, we got a 61.47. Draw a trend line through the peaks, it's climbing, and that's what we came and tested in S&P 500 on Friday. The high touched was 61.87 or 6187.68, and that's a higher high. And what we are concerned about is potentially this is rising trend line of the highs is potentially inverse head and shoulder neckline. The left shoulder of that is a pullback from 6,099 to 57.73 up to 61.47. So if that's the left shoulder, a big large head formed with the pullback or the correction we got, that 22% correction we got in the February to the early April. So 61.47 to 48.35. In a sharp V-shaped move, we came back up to that level. And now potentially what we think is there's a bit of a consolidation range bound pulling back from that level to retest that. We can see there's a beautiful bullish golden cross setting up between the 50-day moving average climbing in blue and the 200-day moving average. After flattening for a bit, it's now started climbing back. And that bullish cross, when both the moving averages are climbing and the 50 goes above the 200, is called the golden cross. It's a bullish trend pattern. And that could potentially mean that we could come back and test that critical convergence level. Where are the two moving averages? They're right at 5,800. The 50-day is at 5809. The 200 is slight above it, 5829. So pullback from that 6187 or 6200 towards the 5800, a 400-point S&P pullback, this next few weeks cannot be ruled out. And that's what we are expecting. And that, in our opinion, would be an immense buying opportunity if we do get that pullback. It would form a beautiful right shoulder of an inverse head and shoulder. And from there, that breakout, imagine from 48.35 towards the 6,200, you're talking about roughly 1,400 points added to 6,200, 7,600. So 7,500 to 7,600 is where we think the upside target of S&P 500 could be in the next couple of years. So a breakout from the right shoulder forming from a 6,200 towards the 58 into higher levels could mean a bullish period for the market for the next several months. So we anticipate good buying opportunity shaping up in the next few weeks as we get this pullback. Now, Bitcoin is reflecting a very bullish pattern called a cup and handle pattern. It also, if you had joined the highs, is tested that rising trend of highs. 108.4 was the December high, 109.3 was the January high, and it tested a higher high at 112K in May. From there, what it is forming is a beautiful handle. We can see that there is a declining channel with the highs at lower highs and lower lows. And that could resolve in a cup and handle breakout. The cup formed between 109.3 to 74.4 is the base of the cup, back to 112. So 74.4 to 112, if you look at the depth of that curve of the cup and you measure that, that's roughly 137.6, 137,600. At 137,000, sorry, not 137. 37,600. So 109.3 to 74, 74 to 112. So 74 to 112 is 37,600. At 37,600 to 112,000, that gives us 149.6, so very close to the 150,000. There's been multiple pundits in Wall Street like Tom Lee, Michael Saylor and others who've called for 150,000 target for Bitcoin in 2025. There's a good possibility, technically looking at this cup and handle, that that's what's in the cards. For those bullish on Bitcoin, continue to hold your longs in Bitcoin, even if though we may get another pullback to the bottom of the channel towards the low 90,000 as the declining set of lows shapes up. Eventually, we expect this to be a bullish breakout above the 112,000. That's what we're looking at. Now, it's come up right as of Sunday. We are recording this on Sunday, and we know Bitcoin trades 24/7. As of Sunday, it has come right at the top of that declining channel at 109,000, at 108,180, around that level. We shall see if it breaks out. If it breaks out of that 112 handle this week. Unlikely, given that VIX, as we talked about, has a potential um, positive divergence in the sense of a higher VIX coming. We expect S&P to pull back to a right shoulder. Given that, we expect Bitcoin to fail at this top of the declining channel and come back to its lower low. That's what we expect. While the S&P pulls back, Bitcoin, a risk instrument, to also pull back. And that would also be an amazing buying opportunity in Bitcoin. Say you get this back in the low 90,000s to the 150,000. That's a 90,000 to 150 is 60,000. So that's a 66% rally or a 66% gain in Bitcoin if you're able to catch it in the low 90 and ride it to the 150. We talked about the US Treasury, and the 1 month Treasury is something very interesting. That basically is a short term yield on the Treasuries and often indicates where interest rates are headed. And what is fascinating is we've always heard that the bond market is the where the smart money trades, is that indicates the smartness of the market. And guess what you see in the US Treasury 1 month yield when the Fed decision came before on September 18th? Through late August, you can see the waterfall decline from 5 point near just above 5.4% towards the 4.65, 4.7%. That itself was an indication that market was pricing in a 50 basis point cut. And that's what we got. Before the 50 basis point even came on September 18th, market had already discounted. The treasury market had fallen more than 50 basis point to discount that rate cut. And that was an amazing prediction of the 1 month treasury yield to predict the cut before the actual cut came. The next movement happened into that into that December cut. We know that December 18th was the next cut. And from late November, early December, we can see that 4.65 towards the 4.25 or 4.3. So that was a 25 basis cuts, as we know. And this discounted slightly more than 25 basis because it had yielded up. But if you take that 4.55 to 4.25, that's the 30 basis point. So the market had already priced in that 25 basis point cut ahead of the cut. So December 18th was around like 16th and 18th, couple of days later. Ahead of the cut, 2 weeks before that, the market already discounted. Guess what's going on in the month of June? We know that look at how steady it has been since that cut in December. Absolutely a horizontal line holding that 4.33, 4.34%. And then into June, from early June, already to the month of June, that has come down from 4.3 to 4.08. 4.3 or 4.08 is 22 basis point. Guess what the rate cut is? 25 basis point cut is what the market expects in July. That seems to be priced in. That seems to be what the bond market is expecting. So as much as Chair Powell has been extremely hawkish, extremely data dependent, and been telling he was at the Senate and Congress last week saying he's watching on the data, market is pushing his hand, saying that we expect you to probably have a cut in that July meeting coming the last couple of days in July, July 29th and 30th. So expect that move priced into the market, and it'll be extremely interesting to see where this 1 month treasury trades. Is it going to be in that bottom of the range between 4.08 to 4.14, kind of where the rate cut would take us to? Because right now we are between that 4.25 to 4.33, around that range. That would come back to that just about 4% on our discount window or on the interest rates when we see the 25 basis point cut in July. So market is pricing that in, and a key indicator of that price cut, of that rate cut, is home builders. That's the ETF, the called the S&P Spider Home Builders ETF, XHB. That's a beautiful cup and handle. We can see that it has bottomed earlier in the year with declining lows. So as the lows were lower low, we can see that positive divergence in RSI printing higher lows. Positive divergence in RSI, positive divergence in MACD, higher lows in RSI and MACD as a lower low in XHB happen from the like 101, 102 to the 84 level. Since then, a beautiful cup and handle, kind of a nice shallow handle of 103 to 84 up to 103 or 102. From there, a handle to a 91, and now been climbing back towards the high 90s, 98, 99. Any indication that this is a confirmed rate cut in July, you can expect this to break out higher. That's what we're watching. The home builders will be a beneficiary of the rate cut. The 25 basis point cut could effectively cause this to take off, is something we are watching on. And that measured target from 84 to 102, that's roughly 18, add 18 to 102, 120, which is what we have seen back towards the last in the November timeframe. Since the November timeframe, we got a waterfall decline, a sharp decline from 125 to 84. So expect some of that decline to be covered back up in the next several weeks as the rate cut comes and the home builders benefit from it. Another sector extremely sensitive to interest rates is small caps. And this is also formed a beautiful inverse head and shoulder. A neckline is beautifully formed at that 209 level, a left shoulder at 196, back to 209, to 171 as the head, right shoulder at 198. So right shoulder is higher than the left shoulder. That's a bullish pattern. Now the 28, 209 turns out to be very decent, good support. It broke out higher, but key is that small cap ETF IWM is struggling at the 200-day moving average to take it out. So that's acting as strong resistance. It keeps testing it, pulling back. 215, pull back to 206. Up to 215 is where it, above 215 is where it closed on Friday. It might kind of be range bound in this low, in the 200 to 215 level. And then we expect, if the rate cut comes, just like the XHB, to break out above 102 to run to 120. We expect IWM, that measured target on the breakout from 171 to a 209 is 38 points. And that 38 point, in fact, 38.3 or something. Add that to 209.55, that takes you towards the 248 to 249. So that's the upside, 248 to 249. And small caps have very good upside. We can also see the bullish 50-day moving average in blue, curved higher and climbing. That's in the next several weeks poised for a bullish golden cross of 50 going above the 200 in the next several weeks. And that would kind of attest to the bullish trends in the small cap. So you're looking at these two key sectors that are interest rate sensitive. So if the cut is coming in and there are more cuts this year, the XHB, the housing, and the small caps are expected to take off. Now, one part which is Barron's in the weekend article talked about bonds have underperformed, why you should own them now, is painted a bullish picture on bonds. They overall feel that bonds have been ignored, but looking at the resilience of the US economy and so on, they believe that the outlook for the rest of 25 is good, with the Fed poised to cut rates. So Barron's indicates that the cut rates is good for the bond market. Now, remember, this is the bond market comes in short term, which we showed the 1 month treasury yield, but then we're looking at the 10-year and higher treasury yields, and the 20-year yield has an ETF that we're watching very, very carefully as a contrarian to what the Barron's article is saying. This is TLT. TLT is the 20-year treasury yield, treasury ETF. It's a long-term treasury ETF. That long-term chart is been testing a very key level of support at 83 multiple times. Tested in 2024, it tested in twice in 24 at 83.23 and 83.4, more recently at 82.99 in the early part of 25. If that breakdown happens, that is actually a very bearish pattern on TLT and a bearish pattern on bonds, as in yields, long-term yields could suddenly have a spark higher. That's what we are watching to be very cautious about. We pray that does not happen, and we pray that Barron's does prove out to be right, that we get a kind of a reasonably stable year for bonds in 2025. But this we cannot ignore. We are cautiously watching this. If this is a breakdown below 83, that measure target is a lot lower at 68 in TLT. That would be a big ouch. It would effectively mean a 10-year yield going to 6% or higher if the TLT breaks down below 83. That's something we are watching. This is something Jeffrey Gundlach has watched and indicated that if we do get that, that would be a buying opportunity for a lifetime in long-term treasuries if you do get that. But it would mean pain this year if this breakdown happens. So that's something we got to be very careful about. The TLT needs to hold this critical level of support at 83. If it does hold it and then break higher above 100, then that could turn out to be a very bullish pattern, because 77 towards 100 is a 23-point difference. 23 over the 100 would take us back to 123, 120. That would be a bullish pattern for TLT. But till then, till this resolution of this head and shoulder, we can see from the 83 to 94.91 left shoulder back to 83, then 98.48 as the head, back to 83, and that 93.4 as the right shoulder, back to 83. That's the pattern that we are worried about. And we can see that the bullish part here, though, is that as TLT formed a lower low from 83 to 77, we got a beautiful positive divergence in RSI. A lower low in price, a higher low in RSI, and a higher low in MACD is bullish. So bulls still have the benefit of the doubt. The bulls would still say that this is just a basing pattern, a nice base being formed between 83 to 100, and we will eventually get the breakout. But that said, the very long-term 50-month moving average in blue is started steepening, coming down. You can see that it has kind of curved since that peak in 2020. And many people say that it was a 40-year bull run in treasuries. 1980 was a peak in yield, and a trough or the bottom of that yield came in 2020. That's when we know interest rates were close to 0%. Since then, there's been aggressive rate hikes. And since then, the bond market is also topped out and pulled back a lot. So people believe that we are now in a secular bear market of bonds. So from a secular bull market of bonds for 40 years, from 1980 to 2020, we've now gone into a secular bear market for bonds. So people believe that the bond market actually will have a downward bias, as in prices coming down, yields going higher. So that's the belief that the bond bears have, and we got to watch this very carefully because this head and shoulder breakdown in TLT could have very bearish implications for the bond market, and that's got to be watched out. With yields going up so much higher, it could be bearish for the stock market as well. So that's the thing that we are watching extremely carefully to see how this all plays out. With that, good luck investing. We wish you the best and talk to you next week. Thank you.